Good morning, everyone. We are in Chapter 4. This clip is the first part of Chapter 4. Chapter 4 is about long-term financial planning and growth. Okay. So let's move on to the key concepts. We are going to look at 4 key concepts in this chapter. And the first one is about financial planning. Let me just get the pointer here. Okay, and the first one is about financial planning. So this is rather conceptual. It talks about the various aspects of financial planning. Then it looks at a simple model of financial planning. So it looks at a very simplified model. Then it looks at a more elaborate model of financial planning. We call this the percentage of sales approach, or more appropriately, it should be called pro forma financial statements. The method is pro forma financial statements, and one of the assumptions used in forecasting this financial statements, pro forma financial statements, will be the percentage of sales approach. Alright, and then these two can be seen as one key concept. Okay, these 2 points can be seen as one key concept. Then the third key concept is about external financing and growth. Okay, so we see some equations in this key concept here. There are 2 types of growth that we are interested in, and we are also interested in the external financing needed by a company or business. And then the last key concept, the fourth and last key concept in the chapter, is about the limitations. Caveats here means limitations of a financial planning model. So there are some assumptions. So if those assumptions don't hold in reality, then this financial model may not be appropriate, or it has to be modified. Alright, these are the elements of financial planning. Okay, so what are the decisions involved in financial planning? So financial planning will involve all the decisions, the major decisions made by a business. For example, investment in new assets. That comes under the capital budgeting decision. We have seen this in the first chapter. This is the most important financial decision, arguably. This is the most important financial decision to be made by a business or a company. Right. So this is involved in financial planning. Then the degree of financial leverage. This is the second financial decision made by a financial manager. We have seen that in chapter 1. So that belongs to a capital structure decision. All right. So the first decision, second decision here, and then the third is also part of capital structure, but this is a separate policy decision. This is called dividend policy. How much cash should be paid to the shareholders, okay, in terms of dividend, in terms of share buyback, and so on. So this is a decision that affects the capital structure. If you pay more to your shareholders, then you would have to increase your debt and then reduce your equity. So in proportion terms, your debt becomes greater, so that affects the capital structure. So this is also a capital structure decision. So these two can be considered as capital structure decision. The second decision made by a financial manager. And now the third financial decision is liquidity requirements. So this is to do with working capital. How much current assets the company should hold, and how much of this must be financed using short-term, like short-term debt or current liabilities, and how much would be financed using long-term debt or long-term liabilities. So this comes under liquidity requirement, or working capital decision. So all these are included elements that are incorporated either directly or indirectly into the financial planning model. Alright, so the process, so the financial planning process is looked at in this slide. So we look at the planning horizon. So we divide the decision into short run decisions, usually the next 12 months, and long run decisions, usually 2 to 5 years. Very few companies plan beyond 5 years. Yeah? They may have a very rough structural plan beyond 5 years, but a more specific plan will be limited to short and medium term. Yeah? This is actually medium, but we call this long. Yeah? For planning purposes, it's long run. But in relative terms, compared to other decisions, then this would be considered as medium term. Alright, yeah. So because planning is difficult for a very long run, let's say more than 5 years, then it's rather difficult to plan. Alright, then we have to aggregate. So this capital budgeting decision that we saw, the first decision that is incorporated into the financial plan, you have to aggregate. That means you combine all the capital budgeting decisions into one project. You cannot treat them as separate projects. We assume that all the projects that we have decided to accept, you lump them together. This is called aggregation. So we take the total amount of financing, or the financing needed to undertake this investment, right? Alright, and then there are some assumptions and scenarios. So first, you make some realistic assumptions about important variables. So these variables are variables that we will see related to the income statement as well as the balance sheet. Then scenarios. You try and run several scenarios where you vary. You change the assumptions. Okay, these assumptions you change. So a different set of assumptions will constitute one scenario. So if you change the assumptions, then you have another scenario. Okay, so that's the idea behind this. And you determine at a minimum worst case or normal case and best case. This is the three scenarios. That means an ideal financial plan should have these three scenarios. So worst case scenario, normal case scenario, and best case scenario. So sometimes we call this pessimistic, normal, and optimistic scenarios. Alright, so why do we do this? Because when we just take the normal case, we would fail to see the risks involved, or the extent of expansion that's required, let's say in the best case scenario. So you will overlook that. So it is best to look at various scenarios. But this is mentioned here. But when we look at the exercises that we do, in the chapter and also in the slide and also at the end of the chapter, we find that the planning horizon is only for 12 months. It's not longer than 12 months. The financial plan we do, will be only for the next year. Not 2 years or 3 years or 4 years or 5 years from now. Why? Because it is more difficult to do. But then you can extend this without much of a problem. So even though it says long-term financial plan, the chapter starts with long-term financial plan, the practices, the exercises in the chapter deals largely or mostly exclusively with short-term financial plan. It doesn't go beyond 1 year. Alright, so this aggregation is assumed, or it is incorporated, but then this is based on this percentage of sales method, as I was explain later. Right, and then these assumptions, there are some assumptions made, and we'll look at the assumptions, especially in percentage of sales method. But we never do these scenarios in this chapter, even though the chapter says that you should do several scenarios to avoid misrepresentation or misunderstanding the situation. But we just take one case, normal case. So we don't do the worst case and the best case. Alright, so please note that when you look at the exercises later, you'll find that we only do one scenario, not various scenarios. Alright, then we also examine the interactions. What is the role of the financial planning? So we look at what is the utility, what's the use of doing this financial plan. First, we examine the interaction between decisions. There are decisions that are interdependent. So if you make one decision, then another decision will also be affected. So these two decisions are not independent. You cannot arbitrarily make both the decisions independently, because if you decide on something, okay, this decision will affect another decision. So these are all interdependent. So by doing this financial plan, you will see clearly which decisions are interdependent and how a decision can affect other decisions or other functions within the business. Right. Then the second utility or use of financial plan is it allows you to explore options. Okay, so you can change the assumption, or you can vary some assumptions or some decisions, and then it gives you leeway to see how you can change this in the financial plan, as you will see. So this allows you to explore options. And one of the major advantages of financial plan is to avoid surprises, because you do all this, you examine the interaction, you explore all the options. Okay, so if something drastic happens, something unfortunate happens, okay, you will be able to survive because you have already planned ahead. So you avoid surprises, because you anticipate the unexpected. You try and anticipate, not all the time, but sometimes when you prepare for the worst case, okay, you will be able to weather through. That means you will be able to see through the difficult times. Okay, so this is a major important factor or point for financial planning. Right, then we look at the fourth use for financial plan. It ensures feasibility and internal consistency. See, when there are decisions that are interrelated, okay, or interdependent, so you would be able to examine, if let's say two decisions don't go well, then you know that there is no internal consistency. But if these two decisions can be taken, and this financial plan allows for the decisions to be taken, then you know that the decision is feasible, that means doable. And there is internal consistency. If you do one, you can do the next decision as well. If you cannot, then there is no internal consistency. So you have to change that so that the two decisions that you make are internally consistent. Okay, that means it can be done by within the same company, given the same context, given the same environment, and so on. So this can allow to the company or the business to see if goals can be accomplished, and if the various stated goals of the firm are consistent with one another. So that's the major role of financial plan. Alright, now what are the ingredients in the financial plan? Okay, so we look at the first ingredient in any financial plan is the sales forecast. That is the starting point. That's the basis. So you start with the sales. Okay, so how much cash flows depend directly on the level of sales. Therefore, it is important to forecast the sales. Then once the sales is forecasted, then you do the pro forma statement. Pro forma means projected or forecasted statements. So financial statements, the two important financial statements will be the income statement and the balance sheet. Okay, so this is important to do. This is the first step, and this is the second step. Alright, then based on the sales forecast, you also, in preparing the pro forma financial statements, you have the asset requirements. You forecast the asset requirement. How much assets you need to have in order to support your forecasted sales. Okay, so that's the third ingredient. And the fourth ingredient, okay, is the financial requirement. Because if you need this much of assets, you need the financing to buy those assets or to obtain those assets. Therefore, it will tell you the amount of financial requirement. And then in this financial plan, there will be this plug variable. This is determined by management, okay, deciding what type of financing will be used to make the balance sheet balance. So what is meant by plug variable? Plug variable means that it is not predetermined. Okay, it's determined out of other decisions made, of some assumptions